All right, let's get back now to the markets and your money because JP Morgan strategist Dubravko Lakos-Buhas is on the tape today saying some parts of this market could be at risk for a fall. He notes that some stocks face what he calls extreme crowding right now, driven by a combination of the Goldilocks outcome, what we just talked about. Everything is awesome, and exhaustion from worrying about tariffs. Now, Lakos-Buhas gives you this rather amazing stat. Quote, this crowding is particularly unsustainable as it soared from the 25th percentile to the 100th percentile in just 3 months. That's the rebound off the tariff lows. That is the fastest in 30 years. So, folks, that's a warning. But this is also all happening, even as Morgan Stanley notes that capital spending is going to boom. You've heard it before, but listen to this. Morgan Stanley writing today that the annual spend on data centers, semiconductors, chips, and other hardware that go into that ecosystem will be about $900 billion per year, which is just a little bit less than all the rest of the S&P 500's capital spending combined. In other words, Morgan Stanley says spending just on data centers alone will be nearly equal to that of every other company in the S&P 500 put together. Wow. Let's put this all together. Joining us, Kristina, Partsinevelos, and I can see from your face that even as sort of I've seen it all Canadian, you are, it has to come up. You are gobsmacked a little by these numbers, are you not?
Oh, the JP Morgan CapEx spending numbers. You know what, gobsmacked, so we're going to reverse it and start with that. You said the $900 billion. The other part of that is how are they going to finance all of those, infrastructure? And it's not just going to be from cash flows. What really stood out to me in that note is that it's going to come from the debt market. So going forward, we should expect a lot more unsecured debt in the private markets, the public markets. For example, CoreWeave. Maybe we can bring up CoreWeave's share price. That's up today because they announced that they're going to be issuing a $1.5 billion bond. And some people will turn their nose up at CoreWeave saying, here's more debt that they're taking on. But if they're going to finance that $900 billion per year on CapEx that you're talking about, Brian, they're going to have to do it somehow, and it's not going to come from their, financial statement, or I should say free cash flows and any money that they're holding on hand. It's going to come from these markets. So I think that also stood out to me as well, that more and more companies are going to be raising money from their debt markets. Now, to go back to the beta conversation.
Well, hold on. We'll go back to that, but hold on.
Oh, okay.
Something we just talked about. What is the risk if that $900 billion number is off by, I don't know, Kelly, couple billion, couple 10 billion? There's a lot of optimism and hope and valuation built into this equity market that number is like lock solid.
To that point, you could see people pull back on their spending. We've seen some contracts end. Micron, for example, is one where they were supposed to, build in upstate New York, and that hasn't really been the case. So there are promises to build. The construction Ohio plant for Intel as well. I know it's not exactly the same because these are chip companies that I'm focusing on, but overall, people can pull back on those promises.
But exactly what you're saying leads then into these high beta stocks. Look at some of these names that are trading, what JPM says is maybe unsustainably. Broadcom, Micron, AMD, Western Digital. I mean, this is the same conversation.
Yeah, it is. And it's just for our audience, the high beta stocks is just what these stocks that tend to move a lot more if the market's going up or tend to fall a lot more than when the market's going down. So it's a little bit different than momentum stocks. To your point, they actually believe in this note, JP Morgan, that those that are not related to AI, so you just mentioned a bunch of AI names, but the non-AI high beta stocks will actually fall dramatically. Even you'll see more of a reversal. So I actually picked randomly 5 names on that list. There's United Airlines, Philip Morris, Tapestry, Goldman Sachs on that name. And so what they're saying is that the herd mentality, there's so many people crowded in these particular names, including those AI plays that you talked about, then any type of negative catalyst can really reverse the share price for a lot of these. And so he's raising the red flag because...
I like that distinction. It's a good distinction. Yeah. There might actually be more to usually we say, well, that popular trend, the crowded trade, well, the AI trade might actually have better fundamentals or at least some legs to it versus, I'm not saying Goldman doesn't or Tapestry or United, but those are like pretty frothy kind of moves.
Yeah, and then it would go to your initial comment about CapEx spending, right? So that's what's driving all of these names higher because these are the picks and shovels for building out these data centers.
But I'm less worried about Tapestry building a factory to make more purses.
No, but that's the point. So those are the names that in this JP Morgan note, because they're not linked to AI, that they will fall more dramatically. And that is the concern. They even, and I quote, high beta
AI
stocks.
spending is cut, Tapestry's going to fall.
No. High beta stocks that are not linked to AI are at a higher risk, regardless of AI spend.
Yes.
They're just saying they're raising the alarm right now with these names,
Bad
particularly, and they're saying it's not on fundamentals. You have this Goldilocks scenario as one, because people are expecting earnings to keep climbing, the Fed to cut rates. Then you have the taco trade, or just the tariff situation that may not pan out. And then institutional investors, which you talked about earlier on in the show, that are getting back in because retail traders, bought the dip. Institutional guys didn't really get in the first half of the year, and now they're getting in. So these are all plays into why you're seeing so many of these names become so crowded.
So very interesting.